right, so the market started the new year on a pretty good note here with a nice opening gap to the upside, but didn't last very long. And around midday, we took a turn for the worse and continued to build on what has been a negative end of the negative few day period here. The famed Santa Claus rally period, the last 5 trading sessions of December and the first 2 of January, which has notably been notably is very positive. I think 80% of the time is positive. But when it has been negative, it hasn't been a very good sign for the markets going forward into the new calendar year. So we're going to break that down, take a look at what we're seeing, how likely we are to continue to get more weakness or not, especially as we go from one seasonality trend to another one, which is the first 5 days of January, how positive or not that ends up being. And then finally, the first full month of January, whether or not that ends up being positive. So we got one day down, and it wasn't necessarily a great day. So we'll break down the patterns, see kind of what we're seeing, what's driving a lot of this weakness right now. And a lot of that has to do with what's going on with the dollar, which may be running its course, considering how parabolic that move has been. So we'll take a look at some of those different asset classes, especially the dollar, how it's been behaving against the euro, what level of against the euro it might be trending towards, and where we have seen similar moves like this in the past, and what kind of moves those have been associated with in the stock market. We'll take a look at all that. We'll take a look at how the sectors have been performing. A notable weakness in a very important sector. We'll take a look at that and see how persistent that looks likely to be. And then we'll take a trade in another very strong sector, recently strong sector, that is also showing some signs of weakness. And we'll talk about how to trade that. So let's go ahead and get started. Today is Thursday, January the 2nd, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. And then at the bottom, click this heart. It opens up this tab. Hit this like button eventually. Hit that like button that pops up there. Same thing here. Click on this thumbs up icon. It opens up this tab. And you can hit that like button as well eventually. Once that pops up, scroll down and click on so right there, click on that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, the S&P is now in an intermediate pullback zone where you have dark pink shading and a red line. We are just under that 2.5, just over 2% down. So we're not quite at that 2.5% mark again, kind of at the same level, about the same level that it was here before the options expiration, before Christmas. And you can see the difference this time is the intermediate line is not only below 50, but it's actually in bearish territory now. Again, similar to this period of time where we actually bounce off of that bull tag and rally. So we're not, it's not quite a done deal per se, but it's looking more and more like we are in intermediate decline on the S&P. Obviously, short-term sentiment's not as bad. So, technically we can kind of still bounce out of this too without it being too significantly bearish. A lot of that has to do with the NASDAQ 100. The NASDAQ 100 got a bull tag a couple of days ago. It's still in light pink shading, yellow line. The intermediate line still hasn't crossed into the lower half of the chart yet. And obviously we're only 1.5% below the moving average, so it still hasn't turned red yet. So it's still helping to hold things up, because the other indexes that are more broad, like the Dow Jones, is clearly an intermediate decline. The intermediate line is actually almost into the lower reversal zone. And then you look at the Russell 2000, and its intermediate line is in the reversal zone, has been for a while. The near-term line, though, potentially forming a bullish near-term low point here, especially if we can, because we actually did rally on the Russell today, especially if it can bounce out from here and then cross. Remember, this is day one of it crossing above 40. The momentum line is below it, so it's not a good sign. and it has to cross above 80 by tomorrow, which is also not looking like a good sign either. So it's not looking like it will be that bullish of a near-term low. Go back to the S&P. Again, it has not crossed above 40 yet. That's when you start to look for the potential for a bullish or bearish near-term peak to form. Once it does cross above 40, where's the momentum line? Is it above or below it? If it's above it, where is it? Is it above the 80th percentile? Ideally, that's the ideal scenario, something like this, where the near-term line crosses above 40. It went from 19 to 59. The momentum line that day was at the 99th percentile. The next day we jumped up to the 98th percentile on the near-term line and we rallied. Right, so that's kind of the ideal scenario. So that's kind of, again, on the day the near-term line crosses above the 40th percentile, you want that momentum line to be as high as possible, ideally somewhere above the 80th percentile, so that the near-term line follows. Remember, the intermediate line is between the reversal zone, so any crossover both above and below it is either bullish or bearish, and so it's not that far away. So it makes a crossover, which happened here as well on that same day. It not only crossed above the 40th percentile, but it also crossed the intermediate line on that day. So the more it crosses, when it does cross, that's a good sign that we might be done with this little bit of weakness. Again, it would just be just a little bit of weakness, as we are barely even flirting with some of those longer term, like the 50-day moving average, way up above the 200, as you'll see here in just a little bit. The Dow Jones Industrial Average, remember, is price weighted. It's been, because the breadth has been so bad, it's been the worst one. It is also setting up right after a bullish near-term peak that was not that bullish because it was a much lower high point. Now we are setting up with at worst an equal low, if not a slightly higher low, and the near-term line setting up for potential bullish near-term low because it's not in the reversal zone. And again, the first day it crosses up above 40, that will be kind of the sign that we watch for. So really important day tomorrow and Monday for that matter to kind of see what the near-term posture does. Remember, tomorrow technically is the last day of the Santa Claus rally. And as of right now, the Santa Claus rally being the 5 days before, so this would be the last 5 days of the year, so it would be 1, 2, 3, 4, 5. So it started on New Year's or Christmas Eve. So this is the last day before the Santa Claus rally started. We were at 59.74. Right now we're more than 100 points down. So it actually works out to be about 1 3/4%. So the Santa Claus rally, remember, when it's negative, especially when it's relatively strongly negative, it's not a good sign for the markets. It typically precedes bear markets in the following calendar year. So this is something to keep a close eye on, as well as the first 5 day signal of January. So day one obviously is down, and we'll keep our eyes on tomorrow going through next Wednesday, because that will be the first 5 days, first 5 trading sessions of January. All right, let's take a look at the weekly chart. As you can see, we have a red arrow now. It's a relatively bearish candle. Here it's been 3 bearish bodies in a row, even if the last 2 were kind of transition. But as of right now, this is a pretty bearish candle, and it does have a red arrow, which we have not had. The Dow Jones Industrial Average has had a red arrow here for a couple of weeks, so it's been obviously a lot more bearish. Same thing with the Russell 2000. It's been a lot more bearish and a lot bigger bodies as well, even though the body now, we're getting a lower close as of right now and a lower low, but the size of the body is above the average, the 3-period average there. So that's a relatively good sign, even if we're just kind of starting to go negative. The NASDAQ 100 is just barely turning bearish here for the first time on that. And again, a red arrow, so we'll keep her, but it's a very small body, so nothing too alarming as of right now. 3 green arrow charts obviously show 3 red arrows across the board. 3 days now for the NASDAQ and the S&P in a row. 3 days as well for the diamonds, though we've had a little bit longer period for both the diamonds and the Russell where we've had 3 red arrows. If you look at where we are relative to these longer term moving averages, the 8 and 17 day have crossed below the 30. We are trading below the 50, but as I mentioned, we're actually still above the value area of the last year, last 52 weeks, and then we are way up above the 200-day moving average. So So if, as of right now, we are not showing a 5% decline. I mean, as of right now, it's only 3.64%. This is the lowest close, and it's at 3.64%. The NASDAQ 100 got to a 5% tag. So this is now officially a red tag. So that won't go away. It can get smaller, but it can get bigger, bigger than that. So right now, the NASDAQ is there. The Dow and the Russell, remember, already had shown, but the S&P still hasn't shown a 5% tag. So we might be done with this move and actually end up building on this green tag right now. I don't think that's the case. I think we'll have a little bit more weakness, enough to get that red tag of just barely at 5% before. Because again, that's a big round number. A lot of people look to buy when we've had a 5% dip. A lot of trading programs are kind of programmed around that. So once we do get that, we've been really close on a high to low basis, right? But this is obviously, this chart's on a close to close. If you look at it on a high to low basis, 532.30, 58.32.30 divided by the high there of 60.99.97, we were right at 4.4% decline on a high, all-time high to intraday low basis. And actually a little bit more, because it looks like this low is a little bit lower than that. So, but I think we will get more of a decline on that, right around to that 5% pullback or so. Let's take a look at some of these other oscillators. We're clearly bearish on the DMI, above 30, below 20 on the negative indicator. The negative indicator is pretty low. It's not below 10, so it's not extreme. But that ADX is rising. The ADX is almost above 30 as it is. Looking at some of the other more bearish indexes, the diamonds are just barely crossing above 25, and then the Russell 2000 also sitting right around 25. So ironically, it's the spiders that has the highest DMI or ADX right now, even if it's down the least from its all-time closing high. When you look at the RSI and the CCI, we're back to bearish levels. So I can keep moving this to today's price. So we're still bearish there. The weekly CCI is not turned bearish yet. It's just barely crossing below zero. So I can actually keep this going to today as well. Because remember, it stops being green once the weekly crosses below 100. And we're not anywhere, as of right now, we're not anywhere near that. Excuse me. But if you look at the daily version, which is what we look at here, again, we've got to cross above 50 and then kind of solidify that. That's what makes it kind of, temporary, like we can shift. It gives you the warning sign. Then you have to go cross above 60 to solidify that cross above 50. So you can see like here, it crosses above 50, and then once you cross above 60, then we go back and stop the red box there and make it green from that point. To really, like, now we've had enough of a bounce that we can say, okay, we're done with this pullback according to the RSI. And the CCI itself, you notice, after dropping way down there below minus 300 on that pre-Christmas decline, it's still really only at the minus 99 level. So that's actually not a bad level to be at here from a bullish standpoint. So it's a good sign for the markets as well. Looking at the Ichimoku cloud, we're in the cloud, but the cloud's still green. We haven't crossed. We don't have a trend anymore. The trend is now below 1 and below 50. So we have, it's in a trendless state right now. You have to be above 50 and above 1 for it to be in a weak trend, which we barely didn't have on New Year's Eve. So now we definitely don't have that. Of course, when you look at some of these others, like the diamonds are below the cloud. We have a negative rate of change, and the cloud has changed to pink over there. And it's a mature trend. Well, it's almost a mature trend. We're above 80, but we're not quite below minus 5 yet on the trend quality. This one, we are also below the cloud. We're also not quite below minus 5 yet. We are above 80, so we're, very, very strong trend, and the cloud has gone pink. So you can see how these trends, we're not even into the cloud yet. We still have a positive rate of change, and we barely just lost the trend on the NASDAQ 100. So it kind of shows you the different stages of the trends that we're at. If you look at the Bollinger Bands and the Keltner channels, we are in the lowest quartile of the bandwidth, of a rising bandwidth that is outside of its Keltner channels, And you can see we're also kind of flirting at the lows today. We were outside of the Keltner channel to the downside. And if you look at some of these, again, more bearish indexes, the diamonds also are closer and has been below that. Some very strong bearish momentum. And the Manwith's really high, and we're in that lowest quartile as well. And then you look at IWM, same thing. Not quite in that lowest quartile and not below the band, but we're flirting with it with some pretty strong negative momentum on the Russell 2000 as well. Let's take a look here at the intraday range. We did get a new 4-week low point today. We rallied back up to yesterday's low, but we did close as of right now below last week's low point and pretty much right around yesterday's low. As you can see, we did jump back up above 100 on the Arun indicator on the negative line, and we're not quite to zero yet. But you can also see we haven't really on this decline here. When in August we jumped up to almost 10% on the size of that candle. Over here on this regular kind of intermediate decline, we also jumped above 5% at the lowest level. That's typically on any typical normal pullbacks that do not turn into corrections. You can see that you typically do cross above the 5%, even on that first leg of this pullback, especially on that second leg, and ultimately on this one. You can see that even there on all these typical pullbacks, we haven't crossed above 5% yet. So it kind of goes to show just how soft and how weak this decline has been, thanks, of course, to the Magnificent Seven companies. Those Mag 7 companies showing some bull tags today. The Apple, you can see, is getting a bull tag today. Netflix is getting a bull tag on New Year's Eve. Tesla's getting a bull tag today. So again, we can either bounce off of these, or we can continue they can start intermediate declines. Obviously, today's volume and trading range was actually a little bit above the average, 10 points there on the HR, 50 million shares trading hands. So when you look at the averages, they're both rising, which is another indication, especially being above this 1% mark on the normalized ATR. That's an indication that we are also in intermediate decline. We're getting higher highs on the average volume. And if you look at the money flow, which is associated with that, we are definitely at bearish levels. We're in the lower half of the chart, but we're also below 40. So again, another sign of bearishness, that we are actually in intermediate decline when the money flow is as negative as it is. Finally, if you look at the volatility index, the VIX, it stopped short of getting above 20. This is another positive development for this intermediate decline. It hasn't been too volatile. I mean, we had that one big jump here, but outside of that, we're not above 20. We're not above even 95%. This is kind of neutral area for volatility. The VVIX is still elevated, but it's not above 110. That's a good sign. And when you look at the VIX relative to its own average values, it's not too high either. It's above its moving averages, and they're all rising, but it's not strongly above any of them. And so we're really kind of avoiding so far some significant volatility. If I take a look at the skew, remember, we kind of keep a close eye on the skew here as another element of volatility. The skew still is very elevated. You can see today's value at 169.16. This has been updated now for today. 169.16. That's still a very, very high level, still sitting pretty much right on its average. And that average is unbelievably high. So remember, we don't really get an intermediate decline start until we break the average and start bringing the average down. Because once the intermediate decline ends, when you break back up above the average. So that kind of is another indication we might be just in infancy stages so far. As much as we've been bearish, especially with the breadth being as bad as it is, we'll take a look at, we're still barely just in infancy stages, that if we were to end it now, would not necessarily lead to a protracted run to the upside. We need a little bit more of a downside move and a much bigger drop in the skew so that we can set ourselves up for, because what we really want to set ourselves up for is a new green box on the zigzag, right? Every time we get a red box, we get a new green box really good number in it. To set ourselves up for a new green box, we need a red box to occur. So we need a little bit more weakness, and then we can get a new green box, ideally again with a double-digit number. Otherwise, if we don't, then we're still building on this one, which is already a big number in it as it is. And like I said, all the other indexes themselves, the Russell 2000's got a red box already. The NASDAQ 100's got a red box. The Dow Jones Industrial Average has a red box. So we're probably not out of the woods yet when it comes to the volatility that we've seen at the end of the year, beginning of the year. Ideally, maybe the next few days we're positive, right? If we can get a good strong day tomorrow that try to offset as much of that negative Santa Claus rally as possible, and then finish the first 3 days of next week really positive too, so we get the first 5 days of January being positive. If we already have a negative Santa Claus, if it finishes negative and we have a negative first 5 days of January, from a seasonality standpoint, that's not a good sign. It typically leads to a not very good calendar year. So that's ideally we might get a little bit more volatility, but hopefully not until the end of next week. All right, now let's take a look at what's driving this price action. So let's come down to the asset class comparison chart, and let's just take a look at today first, and then we'll take a look at the Santa Claus rally, right, that we're in the midst of. So gold, commodities, the dollar. Remember, the three-headed monster is rising commodities, rising dollar, and rising yields. Yields are actually down a little bit today. You'll see here in just a second. Not very much. But gold, you can see it, the gold and the dollar both rallying and bonds for that matter too, is a safety trade, right? That's about as safety of a safety trade as you could possibly get. And with commodities rallying too on the back of a strong dollar, again, not necessarily the best sign that we want to see from an inflation standpoint. Let's zoom out now to Christmas Eve when the Santa Claus rally started. So it started with a bang, fortunately. We had a nice little pop to begin with. But then as you can see, coming out of that, we're down about 1.71%, it looks like, at the close. The Q's down almost 2.5%. IWM is flat during this period. But you can also see commodities have been really strong. Yields have been flat. The dollar's been strong, especially the last few days. In fact, when you look at this, the dollar chart, so there's yields, and you can see the 10-year yield is actually flat today. But you can see the strength of the trend is still relatively strong. The dollar is just parabolic. It got a cluster again today here, including the market sentiment line. The ADX is well above 40, so it's definitely in a parabolic move. I mean, this is about as parabolic as you'll see the dollar index get. Against the euro dollar, you can see we're only 200 some odd pips away from being at parity levels. So basically at 1, if you take a look, just to kind of give you a sense of, we've been near parity before on the euro US dollar. Let me zoom all the way out. Look how far below like 200-day moving average we are. But this is how far below the 200-week moving average. And you can see we were at parity over here. Parity is right at 1, so right about right there. We were at parity in 2022 at the height of the correction, and we're working our way down in that direction as of right now, well below the 200-day moving average or 200-week moving average. And you can see well below the 200-day moving average. Like we are significantly below that 200-day moving average to the tune, which is not very common to be that far removed. If you take a look at it here, let me zoom out so we can see some context on this. Again, we are further in 2022 is when things really hit the fan, and really this 5% mark is kind of where we hit back at the end of 2021 when it looked like, again, post-Thanksgiving, again, another analog to what we saw there. We had a little bit of a rally or so, some weakness in the dollar going into the beginning of the year before things really hit the fan. So, looks very similar now to what we saw then. But outside of that, being 5% below is about the extent that you tend to get, as you saw, the last time there. Now, we were in 2015 when we were in that global slowdown. That was probably the deepest and fastest that we had been below. They're below the moving average, down over 15% below the moving average, and it started again with 5% right here. A little bit of softness in the dollar, but 2014, early 15 set the stage for the correction that we saw at the end of 15-16, with how parabolic the dollar had gone there. Outside of that, again, here's 5% moves. Was kind of the extent of that drawdown in 11, as well as in 2012 before rallying back up. So, considering how parabolic it is, we are at a point where it can end this move, but we also need to be aware that, again, we've been below parity recently, and very well may be below parity again, especially considering the rate hikes that the U.S. has had, that we may not see globally to the same extent. Let's take a look at the breadth. I told you how bad the breadth was. It continues to be bad. In fact, when you look at the summation index for the McClellan oscillator, again, it's down to levels that we typically see during corrections, not just typical intermediate pullbacks, but during corrections. It is improving. We're not as negative as we were. We're only at minus 19. Minus 35 is the number we don't want to be at. So that's not bad. It's improving. The breadth, as bad as it is, but the kind of the reason why it's improving is because it really can't get much worse. When you look at the numbers, talks above their 50-day, we're less than 100. We never got below minus 100 until the depths of the correction in 2022. We didn't get below minus 100 at all this past year. We did at the end of 23 drop below there, but we were a lot further than 3.64% below the moving average when we got down, when we had this bad of breadth. If you look at the number of stocks above their 200-day moving average, it is relatively low too. Again, down at that 275 number. We did break 250 when we were at the worst of that pullback in the fall that was bordering on correction. Otherwise, we typically don't fall below 250 unless we are in correction, as you saw in early 2022. So, and again, in the late 2021, we did dip, similar to what we're seeing now. The average dropping below 320, that's going to be a key number to watch to see if it gets below 300. Because again, that doesn't typically happen unless we are well on our way to a deep pullback, if not more of a correction. So the breadth has been really, really bad. So that it's improving because it really cannot get much worse. The sign that it could be done is when this ratio drops below its moving average. Right? Once we bounce, that's what's going to happen. Is this ratio is going to drop below its average. This is the number of stocks above their 200 relative to the number of stocks above their 50. It's still remaining relatively elevated. As you can see, the skew is relatively elevated too. And this is the number of new highs and new lows. If I were to take a look here, I'd be right. I think it's this one actually. As of right now, let's see here. We have about 108 new lows versus 111 new highs. So we actually have more new highs than new lows. So yeah, it's slightly positive here. That's actually a good sign to be slightly positive. It's above its average. It's obviously not above 100 yet. And I've seen plenty of opportunities where we've bounced here only to fail, right? And when these small bounces fail, it typically leads to more weakness. So we can't fail. We don't want to fail on this little rally we've had, the positive levels. Otherwise, if we break back down below the average and back below minus 100, then we have a new leg lower to the downside. Then we definitely are going to get. And hopefully, again, like I said, and we stay positive for maybe just a few more days through the January effect, first 5 days of January. And then we might, get that red tag late next week, Thursday and Friday, and we might drop back down here. Not too far, but drop down enough. Remember, the number of new lows is kind of a key sign when you're above that 4% mark at 115. That's pretty bearish levels. When you're above it and you drop back below it, that's a sign that we might be done as well from an extreme breadth standpoint. And we're definitely, we didn't drop necessarily to 49, as you can see the number. Well, it actually was 49. The new lows on the New York Stock Exchange dropped to 49. That's well below the average. So more days like that, then more likely we are done with this pullback. If we bounce back up above 100 and especially above 115, then we are definitely not done. So one day obviously doesn't change things, but we've actually had two now. So let's see if we can stack some good days on top of each other, very few new lows, then we can feel pretty confident about this bout of volatility being over with. Of course, the biggest reason for the bout of volatility is, the rate cut odds being taken off the table for the early part of 2025, especially in January. January is highly unlikely we'll get a rate cut. It's 12%. If you look at March odds, the odds of a rate cut are 50-50, or pretty much right on 50-50. So, again, the more that this comes off the table for the March odds, the more volatility we'll see. If we can kind of just keep it around 50-50 and kind of keep it on the table, but maybe not have to use it, I think that's our best case scenario for stocks through March and May and June. As long as we have the cuts on the table, but we don't need to use them, I think that should lead to some pretty good returns for the first half of this calendar year. Let's take a look at the sector moves. Excuse me. And that's a sign, again, that we are clearly in an intermediate decline right now as we speak. If I were to go back to December here, and we'll go to the first day of the Santa Claus rally period, in this case Christmas Eve, you can see XLK, XLY are our biggest losers, and that's really having an impact on XLK as by itself. When you look at its chart by itself here, it is broken at 17-day. In fact, the 8-day has crossed below the 17-day. We're not quite below the 50-day average on the ratio chart yet with the S&P, but you can see like both the relative strength and the momentum are dropping. Momentum close to crossing below 100. If you look at the Qs relative to IWM, that ratio that had gone pretty parabolic itself has peaked and is rolling over. Not quite below its 17-day yet. Obviously, XLK relative to the market has. But look at XLY relative to XLP. That ratio also went tremendously parabolic. Has now broken down too. Got below its 17-day on the 30-day, on the New Year's Eve, clearly below that. So again, this ratio, which is strongly positively correlated with risk appetite, is breaking down. And the more that breaks down, the more likely we are to experience some more volatility. So ideally, we want to see us kind of hold this 30-day and bounce off of this. Doesn't have to keep going up to parabolic moves, but as long as it kind of stays above these averages, that's kind of our ideal scenario. As parabolic as it is, it's not going to stay there forever, but the longer it can stay, the longer we can avoid pullbacks. And it's kind of like taking medicine, right? The longer you can avoid taking medicine, the better. But once you take the medicine, then it's like, okay, once we get a red tag, we'll get a good green tag after. It's just the fact that nobody wants to experience a red tag. I don't want to experience a 5% drop in equities, and you don't want to experience a 5% drop in equities. We want to avoid that as long as possible and try to make, sorry, not this chart. We want to make this 17.5 number as big as possible, right? That's the goal. That's what we idea. But once we do get a 5% tag that nobody wants to experience, that's a good thing, because then we will get a green tag after with an even better, like with a good number. So instead of trying to squeeze out 1 or 2 extra percentage points out of this one, we'll get a new one with the double-digit numbers. But again, that means we have to experience them, and no one wants to, and that's a 5% drop. Nobody wants to experience that. In fact, when we do get them, the TV kind of goes nuts, right? They have market in turmoil, and they bring people on talking about whether or not we're going to be in a bear market. And it's like, it's just a normal 5% pullback. As you can see, we get plenty of them, and after we get them, it's great, right? The markets are great. So it's the medicine that nobody wants, but sometimes we kind of need. All right, that takes us to our trade idea of the day. Let's take a look at Wynn Resorts. You can see how bearish it is. It's gotten oversold clusters. The intermediate line is crossing back into the reversal zone again. Both short-term sentiment lines are down there. We are well below a falling moving average. Dark pink shading. You can see the bearish near-term peak we just barely had. Obviously, we're also crossing We have a bearish candle on the weekly chart, but you can see they were crossing below the 200-week moving average, 40-week moving average, excuse me. The 40-week, which is our proxy for the 200-day. But you can also see the 10-week is crossing below the 40-week, so we're getting a little bit of a death cross there on and a clear bearish candle there. From a 3 green arrow standpoint, we obviously have 3 red arrows right now, again, well below the moving average. In fact, we are crossing, as we speak, below, below the value area, on the bottom of the value area, into a gap of volume until you reach the 52-week lows, where we have kind of a sideways base there that will act as a support level. When you look at some of these other oscillators, like the DMI, it's at bearish levels here. We're above 30 on the negative indicator, below 20. The ADX is just rising, just barely crossed up above 20, so that will turn light pink there tomorrow. If you look at the RSI and the CCI, they are also at bearish levels, below 40. Have been below 40 now here. It's been below 50 for a while, but finally kind of crossed that, been below 40 past few days. Obviously well below minus 100 on the weekly chart. We are just barely crossing the minus 100 level. So that kind of matches up with the death cross we are seeing on the long-term moving averages. When you look at the Ichimoku cloud, we are below the cloud. The cloud is definitely pink. Very strong negative rate of change, and we have the beginnings of a bearish trend developing that has now moved to intermediate strength there, up above 65 and below -2. And then finally, looking at the Bollinger Bands and the Keltner channels, we are in the lowest quartile of the band width that is rising, and we are below the lower Keltner channel, in between the Keltner channel and the band width, with some negative momentum to the downside. So what we decided to do here, considering how bearish it already is, instead of doing a more directional trade, we do a bear call spread, sell the mid-30 delta, the 90 by the 92.5. That puts us right about here. You can see it's down a little bit since we put it on during the Market Outlook Live, and puts that break even above 90. So that break even's way up here. We essentially have to break up above these moving averages for it to get out. And we'll try to get as much of a return off of that as quickly as we can, since we have 30 days till we get to that 20-day window. So I can get 50% of the maximum gain early, then we can take it, right, and grab it and put this money to work somewhere else, again, with plenty of time left if we can get it quickly. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or any comments that you have. Reply to anybody else's threads. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all tomorrow.